And with that, we're going to go ahead and get started. All right, so you take a look at the cotton market. We're still calling it range bound. You take a look at prices going back to November. We have generally been moving sideways, but that is not to say that there hasn't been some important action. In particular, you take a look at the market since late June. We've migrated from values that were floating around 78, below 80 cents per pound, and they've gone all the way up, and they've been touching levels close to 90 cents per pound recently. So prices are staying within this range that we've had for the past 10 months, but 10, 11 months, but still not to say that we haven't had some important swings during that time. One of the reasons why we're calling this range bound, not only because we do have these, upper and lower bounds lines that we can draw, but also it has to do with where the market's been as well. So if we take a little bit longer term view, the market has been a lot calmer place despite some of the swings we had, such as that 12-cent per pound move that we've had over the past 6 to 8 weeks, just relative to where we've been. So if we rewind the clock a little bit, take a look at where we were pre-COVID. We had to climb up to get to 70 cents per pound. We had the trade dispute that was affecting the market back then. As we got to the signing of the phase one deal, there's some more optimism coming in. We got up to 70 cents per pound. A lot happened with stimulus. Everything rallied, bought cotton prices higher. We did have a lot of moving and shaking as cotton continued its upward trend throughout 2021 and 2022. We did see, some major events occur too. Outbreak of war in Europe, a little bit of a blip there, brought demand lower briefly, but then we had some supply concerns that helped bring the market higher. A major event that's still with us and something that we'll touch on throughout this discussion is the influence of the Federal Reserve and how they have been increasing interest rates. There was a little bit of a lagged effect there, but I think, the actions by the Federal Reserves and other central banks around the world helped reverse some of the optimism that did exist in the macroeconomic environment and led to that big sell-off that we had last summer. Since then, we have seen cotton prices bounce around a little bit. Some fluctuations with USDA changes to their numbers. Last year, we have had some major threats to supply that occurred last crop year as well. Just bringing that up because I do want to highlight how that demand had trumped supply. And even though we did have some concerns about supply, particularly from countries like Pakistan last year, we saw the market fall despite that news. So all that brought us to this range-bound trading where we've been since November. You take a look at where we are once again. We have had this good swing in prices. We went from levels 78 cents per pound, now up close to 90. Take a look at this window here. This coincides with some rising concerns about our crop, particularly some concerns that we had out there in West Texas. So when we take a look at the recent move that we have had within this range, supply concerns have got us to the upper end of that level. I think to hold on and maybe build from these gains, I think we certainly would need to see the demand environment improve. You take a look at the market more recently, we have had a string of lower lows if we continue to add more lines onto our chart. And that's something that, we may need to pay attention to as time goes on. So this is, just setting up our price discussion. We're going to begin talking about supply, and then we're going to lead into some discussions about demand. And when we take a look at, global supply situation, of course, the U.S. Is very important. We are still the world's largest exporter of cotton, and we have seen a lot of volatility in our outlook, particularly from the production side over the past few months, gearing us up for this crop year for the harvest you guys are getting ready to collect. So just as a refresher, we got about a third of our planted acres out there in West Texas. Of course, there's not a tremendous amount of irrigation out there. When we were getting our initial estimates for this crop year back in May, there was a lot of red out there in the West Texas area. Of course, we've had several years of drought out there. There was a lot of concern that we would have, continued difficulty in growing conditions this year, given the very severe conditions we had last year and a record abandonment that we did have last crop year. As time went on, we did see some rains come as we got to the closing of the planting window out there in West Texas. We did see rains that were sufficient to even cause some flooding out there. As a result, we saw a lot of this red that was out there in West Texas and in the Panhandle move out, and we did see it replaced with some much lighter colors that we're a little more happy to see. through July, and we continue to see drought monitor numbers improve. These numbers that I'm pulling, are every month. These are just ahead of the USDA WASDE update. So I just want to give you an idea about, why we're looking at these particular maps here. As we got into August, though, we did see things get worse. So we saw yellows turn to brown, and we did see some red move back into the region. And then, of course, once we got to September, when we did have high heat and winds and not a lot of rain coming through, things got to be a lot more red again. Also want to highlight it's not just Texas. Of course, Oklahoma's having a lot of challenges as well. Also, you can see the southernmost regions of the Mid-South also suffering from some very dry conditions too. So what that has meant some changes in our condition ratings. So here's the weekly USDA crop condition ratings. And you can see that as time went on, what I've got here is dark line. This is current crop year numbers. The lighter line is showing you numbers from last crop year. Once we got into late June and into July, you can see the darker line taking over. That means that this year's numbers getting worse than last year's numbers. When we did see that happen, that's when we started to see cotton prices move higher. So we made that move up and over 85 cents per pound. That was when we saw these crop conditions get a little bit worse. And I think it is worth pointing out that, even with last year's record abandonment in Texas, we actually have worse condition ratings this year than last year. That may be because we have less acres dropping out of these ratings, but just wanted to give you some flavor for how difficult conditions have been. Here we got parallel numbers just for the national level. You can see the timing is a little bit different. We didn't see this year's ratings really start to move up and above the ratings from last year in terms of the difficulty of growing conditions until a little bit later. So this is after the change we already saw in prices. So in terms of what was driving prices when we saw crop conditions in Texas get worse, we saw the market move several cents per pound higher. And of course, that's not the kind of move that we'd like. We'd rather to see that come on from demand growth rather than supply concerns, but that's where we're at. And we have seen that show up in USDA numbers as well. So here we've got USDA forecasts released in different months early on in the season. Since the weather hasn't been experienced and there's a lot of difficulty predicting the weather, we start out with assumptions of averages for abandonment, averages for yields. That was giving us a crop number up and over 16 million bales. But as we got into some of the more detailed numbers that are informed by the weather, we did see some significant changes. As was the case last year, we saw a significant reduction that occurred in August. Just to get in the weeds a little bit, there is a change of the agency within the USDA that handles the estimate as we transition from July to August. Changes in methodology can also result in some changes in the numbers. Here, just over the latest report, we did see another stair step lower with another about 900,000 bales coming out of U.S. production back in September. Expected to produce about 13 million bales right now, which is smaller than the crop that we had last year, despite the record abandonment that we had in West Texas last year. So here, just for comparison, I want to give you an overview of how the USDA numbers changed last year. We did see a big reduction in August, a little bit bigger than what we saw for the current crop year. This helped goose the market higher when we were in August of last season. Also last season, something that helped production out over time or production numbers was that yield forecasts started to increase. So those yield improvements ended up causing the final USDA number to be about 2 million bales higher than it was back in August. So we did see some cotton getting taken out early in our estimates. We saw it get put back. We do have questions about whether the same pattern may happen this year or not. If you take a look at yield projections in most regions across the country, they're not expected to be quite as good as they were last year. So we maybe do have a yield challenge in terms of trying to replicate the pattern that we had last year. Something else that's affecting our numbers when you think about production, it's not just yield, it's also how many acres we have. And we have seen some volatility in our acreage numbers over the past few years as well. So what I've got here is just the transition and the acres planted forecast that changes between August and September. We do get some new information to the USDA when we get into September. They have some information regarding how many acres were certified for registered for programs. With that additional information, they generally fine-tune their acreage numbers in September. But when we take a look at the shifts that have occurred over the past couple of crop years, it's been a little bit more than fine tuning. So last crop year with those high prices that we had last spring, so ahead of the 22-23 season, we did see acreage increase. So initial projections for planted acres weren't quite sufficient. We saw a 10% bump in acres planted in September. September is a little bit distant from planting, so that's a pretty big revision, particularly compared to where we've been historically. This year, with the swing lower in prices, of course, we're having lower planted acres, but we did see a sharp reduction in acres planted in the USDA's September report. We lost about 860,000 planted acres in the numbers just last month. And, just for some context, there's only 2 states that grow more than 860,000 acres. So that was a significant reduction. And then we think about, the production forecast. Are we going to be able to have a rise in production such as we did last year as time goes on? I think we got some challenges. We got some challenges because instead of having an acreage increase, you have acreage decrease. Then on top of that, I don't know that we'll have the same yield follow through that we did last year as well. So we do have a small crop. This looks like that crop may end up staying smaller instead of recovering a little bit like it did last year. And that's something that maybe could help out or continue to help out the market. Here's a breakdown of, how the global picture's shaping up in terms of production. So on the right, you've got a breakout in terms of, cotton production this year. On the left, you've got the year-over-year change. Globally, we're expecting about 4 million bale reduction in the cotton harvest. A lot of that's expected to occur in China. In China, they did plant a little bit less. Growers in other countries are responsive to cotton prices relative to other prices. Even though they do have some price support out there, we are seeing lower plantings in China. Another factor contributing to their decrease is that they're expected to have lower yields. Last year, they had excellent yields. They had a bumper crop. This year, a return to average. Average yields is dropping their number in a pretty significant way. There are some other weather concerns out there. In India, they're dependent on the monsoon to bring most of their annual rainfall. That occurs between June and September. It got off to a good start, but it has faded since then. So we're seeing optimism regarding the Indian crop start to fade. For us, there's some relevance there because India can export some cotton. If they're growing less, that could be more export opportunity for us. Right now, we're down about 500,000 bales year over year. Brazil down, expected primarily due to change in acreage. Pakistan had floods last year. They're not expected to have floods this year. That's expected to contribute to their rebound. Pakistan has been an important import market for us. So we may see some reduced export opportunity to Pakistan due to their improvement in their crop. Australia, essentially flat. They've got water. They're growing a decent amount of cotton. West Africa, improvement growing conditions expected to help them out a little bit. Turkey, growing less. Turkey, of course, is an important export destination for us. If they're growing less, that can open up some export opportunity for us. Somewhat relatedly, too, it doesn't show up on our list of top producers, but Greece actually grows a decent amount of cotton, and they've gotten hit by severe floods here in recent weeks. A lot of that Greek cotton goes to Turkey. If that's not available, once again, that can help boost our exports potentially as well. So we've got our problems. There's problems elsewhere around the world, but problems that are out there maybe open up some doors, may help us open up some doors for exports, which could be, beneficial, particularly given where we are in terms of the global macroeconomic situation. So when we start putting things together, we can back up our global production against our mill use. When we do that, current USDA figures are indicating a slight production deficit. Normally that can help out prices, but take a look at the size of the deficit. It's about half the size of the surplus last year. So, we're going to be taking a bite out of what we put into the bank last year. May or not be enough to move the needle. And then something else that's really important to consider is that there are a lot of questions on the demand side in the cotton market right now. USDA has got about 5-6 million bale increase penciled in terms of increase in mill use. Take a look at the spinning situation around the world now. It's not so great, but there's a lot of time left in the crop year. There's some time for improvement, but given the fact that we're not there yet, there are some questions about whether or not this number may or may not be too optimistic. So we'll start taking a look about that in the next leg of our discussion here. We'll start by taking a look at export sales. So one of the most timely indicators for demand we have out there in the global market is the U.S. export sales reports, which come out, of course, every week. You take a look at commitment for this year compared to last year, we're down by about 1/3. We do have a smaller crop, but the reduction in commitment relative to the reduction in production does indicate, that we do need to sell some cotton if we want to keep prices supported. Things can turn around quickly. We've got a lot of time left in the crop year, but so far things have been a little bit slow. One bright spot that has been out there has been China. Particularly when we take a look at the first half of the summer, there were some relatively decent purchases coming out of China. A lot of that was thought to be associated with the Chinese government, either Chinese trading agencies or the Chinese reserve system. Not mill-related demand, which we would like to see, but at least there was some buying that occurred then. And more recently, it has tailed off, and it's tailed off even though the government has released some quota. So within China, if you're a spinning mill, you can't import unless you have a license. They did get more licenses released, but there hasn't been follow through in terms of mills making buys against those licenses, not yet. So sort of a mixed bag with China, but hopefully that situation will evolve and we'll see some improved sales. Something that may help that is just some cotton price dynamics. What I'm showing you here is a mixed up soup of cotton prices from around the world. What you'll see, the red line at the top, that's our Chinese cotton price. Generally, Chinese cotton prices are the highest of all of our cotton prices out there. There are a couple reasons for that. One is that quota system that China has, which can provide them some insulation from outside markets. Also, there is a difference in delivery terms where that Chinese price gets cotton all the way to a mill's doorstep as compared to these other prices, which may just get it to a port or just may get it to a trading location. The reason why I wanted to highlight that is that things have been different in China recently. We take a look at Chinese prices traditionally being higher. They did cross our international prices last spring. I think that was a signal, that prices had gotten too far and that we may be setting ourselves up for a drop. This is something that occurred on the backside of the 2010-2011 price spike as well, with Chinese prices crossing other prices. Something else that's been unique to the market in recent years is that Chinese prices are actually the lowest of all of our benchmark prices last summer. China is the world's largest spinner, the world's largest importer. If Chinese prices are lower, it's an indication of weakness in demand, and that our other prices may potentially need to move lower. But something that's a little bit more optimistic is that Chinese prices have been returning back to their traditional premium relative to the rest of the world. So one of the reasons why China is the world's biggest importer is because the price differences there make it attractive for them. So we tend to see Chinese prices 15 to 20 cents per pound higher than our A index price or our global cotton price. We have been getting back to that level here recently. And then something else I want to point out too is that Chinese prices started to rise before prices everywhere else. They've been flatlining a little bit, but that premium's still there. There may still be some incentive for China to import. That's something that we're watching. The mixed up or divergence that we've seen in normal price relationships has started to correct itself here. And that may be something that could help support the market. Help support the market not only in terms of fiber trade, but also potentially help it in terms of yarn trade. So on top of being the world's largest fiber importer, China is also the world's largest importer of cotton yarn. If we rewind the clock a few years, China's importing 8, 10, 12 million bales equivalent of cotton yarns. That's a very important source of demand in terms of our spinners around the world. But since Chinese prices were lower, that meant that Chinese domestic yarn prices were lower and that Chinese yarn import demand fell off pretty sharply. That meant that spinning companies that traditionally sold to China had to look to new markets. So if you were a spinner, such as those in Vietnam, which traditionally sell a lot of cotton to China, if China's not buying your yarn anymore, you're going to look to other countries to try and sell some of the yarn that you're producing. An effect of that is that when these other spinners go out into the world market, that increases competition, that can put pressure on margins. And spinning mills are already facing a lot of pressure for profitability, given the fact that they may have bought some cotton that was expensive around the time of that spike in the previous crop year. When prices decrease, they'll continue to take shipments and having to sell into a lower priced yarn market. So all these factors together mean challenging situation for profitability for spinners globally. But things are starting to look a little bit better. Here we can take a look at Chinese yarn imports. You can see the big drop off they had as domestic spinning was a little bit more competitive compared to international yarn prices. It has been rebounding, but we're still not back to that 8 to 10 million bale range where we were before we had the price spike. So things are getting better, but demand is not quite all the way back to normal yet. There's still some recovery to take place. And when we take a look at demand, we can take a look further downstream as well. So going from yarn, we can take a look at apparel. The world's largest consumer of apparel, of course, is the U.S. In the U.S., one of the statistics we track relative to the apparel market is consumer spending on garments. These are in constant dollar terms. There is adjustment for inflation in here. And, something I want to highlight is that, over the past year and a half or so, despite some of the challenges we've had on the macroeconomic front, consumers have been hanging in there in terms of their spending purchases on apparel. We haven't been having growth. Traditionally, we have growth 2 to 3%. We've been essentially flat for the past 18 months, but we're flat at levels that are up about 20 to 25% compared to where we were before COVID. So we still have some strength of demand there. There's still some rebalancing in the U.S. economy as consumers shift between services and goods, but apparel spending has been holding up pretty strong despite inflation, some of the other challenges that we have on the economic front. Something that may challenge consumer demand as we get further out, however, are retail apparel prices. So this is our CPI for apparel. So an average for garment prices across the U.S. Something I have been able to say for the past couple of years or past year or so is that, we take a look at the changes in retail prices. Of course, inflation is an issue for the overall economy, but when we take a look at apparel prices, a lot of the increases that we've had year over year were more reflation or just getting back to where we were before COVID rather than outright inflation. But if you take a look at some of the growth that we've had in prices more recently, we're moving beyond price levels that consumers had before COVID. Consumers for apparel, of course, like to bargain shop. So as we do see prices move further beyond levels where they've been historically, I think the headwinds for maintaining this consumer demand may get a little bit stronger. You flip the coin, take a look at the retailer side. So, of course, retailers are having to buy garments to sell garments. We've seen a lot of volatility there as well. And one of the reasons why we've probably seen retail apparel prices move higher is that they've been having to pay higher prices for the garments that they're sourcing. So this is the average price for imports. We did set a record low or tied a record low in the spring of 2021. There's about a 12-month lag in terms of apparel sourcing. So spring of 21, that's about 12 months after a shutdown period in 2020. So we had really low prices that were negotiated during COVID, and they showed up in the spring of 21. Since then, we went from a record low to a record high. So huge volatility in terms of our sourcing costs. This is not unique to cotton. It's not just fiber prices involved here. We've got labor, we've got shipping, you've got everything else that's been involved in the inflation outlook driving those prices higher. But these record high apparel prices are contributing to higher prices, probably at retail, as retailers are trying to help preserve some of their margins. We do see average import costs moving a little bit lower, but they're still way higher than they were relative to pre-COVID. And this also gets us into some questions about inventory. So this is an issue I know Barry brings up a lot, and it is something I think is important because it is a potential source for optimism out there on the demand front. Unfortunately, there's just not a lot of good data to track it. One of the few sources that we can look at for inventory is the inventory sales ratio that's put out by the Census Bureau, where they take the value of retailer inventories and divide it by their sales. So you take a look at these figures. Of course, COVID stands out. There weren't a lot of sales during that shutdown period, which drove that big spike. Given that big spike, we sort of need to get it out of the picture. So if we just truncate our chart here, we can take a look at inventories more recently. And when we do take a look at those inventories more recently, we can see that they were a little bit low. This is the shipping crisis when retailers are trying to keep up with consumers. But they have moved a little bit higher recently. A lot of concern about inventories at the retail level. In terms of this value or this ratio, it's not showing inventories being out of control. We're not sure how good the data quality might be for these numbers, but it's one of the few tools we have to track. A lot of questions in terms of how you deflate as well. Do you deflate by your sourcing cost? Do you deflate by retail price? If you just deflate by sales, which is your retail price, we've got inventory still being a little bit lower than they were pre-COVID. But if you talk to retailers out there, maybe some of them here on this call, they'll tell you that they're still having issues in terms of how to deal with inventory. Some shipments coming in are still going into storage rather than being put onto shelves. But this process is correcting, and it has been correcting in a big way. So another chart related to the U.S. Retail situation and how that may filter in terms of additional orders that may be coming through the pipe. This dark line is showing you consumer spending on garments. So once again, we're treading water. We're not growing, but we're not falling off, which is great. But then you take a look at our import volumes, they've gone way down. So due to concerns about the macroeconomic situation, due to concerns about the trajectory of spending as it goes forward, we've seen retailers be very aggressive in turning back their orders. If you take a look at apparel imports on a weight basis, the volumes coming in for apparel of all fibers over the past year has been as low as we've seen going back to 2002, 2003. So consumer spending is certainly much higher than it was 20 years ago, but we're importing volumes that are the lowest that we've had in 20 years. So at some point, that's got to catch up. At some point, this inventory issue has to resolve itself. When you take a look at the import volumes they bring into the U.S., some of the volumes they bring in recently in terms of cotton equivalents have been around 10 million bales. With consumer spending at the level it is, we probably need something like 14 million bales. So, just the inventory correction alone could be, 4 million bales of additional cotton that needs to come in. And that could bring us a good way towards that 6 million bale increase that the USDA is projecting in terms of their year-over-year increase for mill use. But we've got some other issues out there. And one of them, of course, is just the overall macroeconomic environment. And a major factor affecting the macroeconomic environment, of course, is interest rates. So here, I just want to paint a little bit of a picture in terms of how interest rates can affect the economy and maybe factoring into our price outlook for cotton. So what I've got here in gray is recessions. This dark blue line is showing you interest rates that the Federal Reserve controls. And I just want to highlight the significance of what has occurred in the Federal Reserve interest rate increases since just March of 2022. So it's only been about a year and a half. So rewinding the clock, going back to the late 1990s, Federal Reserve increased interest rates 2 percentage points. That was enough to bring about the dot-com crash. Federal Reserve increased interest rates about 4 points. That was enough to help trigger or expose some of the issues in housing and bring about the financial crisis. After that, we went as low as we could go. To help stimulate demand following the financial crisis. We did see the Federal Reserve increase rates 2 to 3 percentage points as to trying to get back to normal, but they had to pull back on that with the trade dispute. And then, post-COVID, the Federal Reserve was doing its fight against inflation. They've increased interest rates already a little bit more than 5 percentage points. So the increase in interest rates this time compared to other recent times is bigger in terms of the size of the change. So that's why we're having a lot of concerns about recessions, because when you do take a look at other increases in interest rates, we do see recessions tend to follow. But of course, the counter argument is that the labor market has been holding up really well. We've got unemployment rates below 4%. There's only a handful of times in modern history that has occurred. The strength of the labor market, the strength of employment, some of the strength we've had in wage growth has been supporting the U.S. economy and helping us keep away from recession despite this very significant increases that we've had in interest rates. But something else I want to point out is that it's not just the U.S. So here's the same chart that I had before, just taking the recessions out of the way. But I just want to show you that when the Federal Reserve increases interest rates, other central banks tend to follow. So the central bank in European Central Bank has essentially been following in lockstep with the U.S. One of the reasons is because they don't want exchange rates to get out of control. They're worried about inflation in their own markets. UK, Canada, all Western economies essentially have been following along with the U.S. in terms of cranking up their interest rates. All these interest rates are the highest that we've seen since the financial crisis for all these major Western economies, which are also major consumer economies, which ties us back in terms of downstream demand. And we can see effects that are expected to show up in terms of economic growth. Economic growth is one of our best predictors for changes in cotton consumption. U.S. growth in 2023 expected to be below where we were in recent average, expected to be even slower in 2024. Take a look at the EU. Their bottom's expected to occur this calendar year, but they're still going to have slower growth than what they had over the 5 years leading into COVID. Europe right now is in recession. Germany's in recession right now, their biggest economy. So slowdown is in place for Europe. And then for UK, of course, similar situation as well, a little bit steeper dip that they're expected to have this year and very slow growth next year. So take a look at, Western economies, growth expected to be very slow due in part to inflation and increases in interest rates. But the same story isn't true everywhere. Of course, China's been grabbing a lot of headlines in terms of their economic growth challenges here over the past couple months. China has developed into a major consumer market as well. The issues that they're having there, of course, are going to trickle into slower consumer demand and another weight on the demand side of the cotton market. Here's just, Japan, a much smaller market, but they are the world's third largest importer of apparel. A little bit distant behind the US and the EU, but do want to highlight them here as well, expected to have slow growth. Instead of trying to slow the economy through higher interest rates, both these economies in Asia are trying to stimulate, which really is the bottom line here, is where is the growth going to come from? If we've got higher interest rates in the West, we've got these growth challenges in the East, where's the strength of consumer demand going to come from to help pull our demand side of the cotton market up and help create that tightness that can bring additional support to prices. So bring anything back in terms of our full picture, we're looking at lower production this year due to lower acres. And we also got some weather challenges out there. USDA's got a pretty good increase in mill use factored in there. We could get there given some of the inventory corrections, but there are a lot of still questions regarding where consumer demand might be given slowdown in economic growth around the world. Boil things down in terms of where we're expected to be in terms of stocks. Since we are expected to have a slight deficit this year, we're expected to have stocks be a little bit lower than where we were at the end of last crop year. But otherwise, if you take a look at where we are compared to recent years, we're expected to have ample supplies. We'll be behind where we were last crop year, behind where we were during COVID, behind during this very special time when China had super high government stocks, but otherwise higher than where we've been in other recent crop years. So there is cotton out there. That's something that we're going to have to watch in terms of its potential to weigh on the market as we get further out. So future prices have been testing the higher end of the range. A lot of that has been due to supply concerns. Planted acreage is lower due to lower prices that we had in the spring. The weather has taken a turn to the worse, which is amplifying some of the effects of lower acreage. But on the demand side, we're taking a look at slower economic growth globally. The question is, where's the growth going to come from to help create that scarcity, to help pull prices up that next leg. Lower supply supported prices, but we really need the demand side to follow through in order to maybe keep the market where it is, or certainly to get any improvement. So that's something that we're going to have to watch and continue to watch, is if we might see any uptick in demand. The inventory correction is something that can help us, but in terms of our macroeconomic factors, I think that we do have some challenges. So that concludes my thoughts. Certainly welcome any comments or questions that you guys may have.